Hi, I'm Jeff Banks from MW Lomax, and this is the Banks Report.
The Banks Report, a commentary by noted property and business tax consultant Jeff Banks. Jeff is not your ordinary accountant and speaks in words and terms that you understand.
In my practice, I help people who are working hard using property and self-employment to help them reach their financial goals. Some of the many questions I get asked are, what is the best way to structure loans? If I use the equity in my principal place of residence, am I going to pay tax on my home? And fixed rate loans versus variable rate loans. So let's deal with the simple one first. If I borrow against my home, is that going to make it effectively a capital gains tax affected asset? The answer is no. Simply using the equity in your home for investment purposes does not cause the asset to which the loan is secured to be subject to capital gains tax. It's the use of the property that defines the taxation of it. If, however, you are using all or part of a property as a rental investment or business premises, you would then assume that some part of the increase in value of that property during the period that it was income producing will be subject to capital gains tax. On the structuring side, the best advice I can give, other than first consulting an advisor at MW Lomax, is that when borrowing to invest is to ensure that you have quarantined any investment loans apart from private loans. In essence, the mortgage specific to the purchase of your principal place of residence should be totally definable from the investment portion, even though both may be secured on your own home. It makes sense to ensure that any interest saving strategies, such as using an interest offset account, are attached to your non-deductible debt. Many advisors talk about good debt and bad debt. All they are talking about is debt to which interest is deductible and debt to which it is not. It makes sense to reduce your non-deductible debts as quick as possible or converting it to deductible debt if possible. Further to that, please do not mix the purpose of any loans. There is nothing that frustrates accountants more than the calculations required to separate the deductible from non-deductible interest in a loan that has been used for both investment and private purposes. The third question, and perhaps the most vexing, is fixed interest versus variable rate interest. Without wanting to give specific advice, to me it makes sense to quarantine and maximise the interest deduction I am getting against my rents, whilst not trying to advocate negative gearing. To me, if possible, we should lock in rates against investment properties whilst attacking the non-deductible debt. To this end, I would suggest a variable rate loan against your home with an interest rate offset account attached to it to allow the greatest possible benefit of any spare funds, while your interest-only investment loans continue to deliver tax deductions at the highest possible level. Of course, once your home loan is paid off, the strategy may very well change. As always, the opinions here are general in nature, and when looking at any strategy specific to your needs, you should consult a professional. If you think that should be MW Lomax, please do not hesitate to contact my team and I here at property@mwlomax.com.au for structuring of investment loans, or mortgages at mwlomax.com.au should you wish to use one of our experts to get you the best loan for your next investment, or simply review your existing loans.
The Banks Report is created by Jeff Banks of MW Lomax, a specialist financial services firm offering strategic advice and services you need in property and business, including accounting, taxation, finance, financial planning, risk insurance, superannuation, and business advisory.